And welcome everyone to the presentation of the Conservation Trust Fund Investment Survey for the calendar year 2018. My name is David Myers. I'm the Executive Director of the Conservation Finance Alliance. And we are really pleased to have Katy Mathias present these results. She will also get into some longer term analysis that's been going on, and what we're going to do is we'll have Katy's presentation, and then when that's over, we'll have plenty of time for questions. To ask a question, let us know that you're interested in asking a question by either putting the question into the chat box, or by just letting us know via the chat box that you'd like to ask a question. Then when I call you, you can unmute your microphone and ask the question directly. And we're really looking forward to your observations and feedback on this. And we have more webinars coming up in the future, and Katy will tell you a little bit about them at the end. And so now over to you, Katy.
Great, David, thanks. Hello, everybody. Good morning or good afternoon, depending on your time zone. Thank you all for joining us. I am really excited to share some of the initial findings, both from the multi-year study and also from the 2008 data. I know that 2008 seems like a long time ago, and that's true. By the time we get the data in and compile it, we're usually running a lag from the end of the calendar year. I'm Katy Mathias. I'm the co-author with Ray Victorine of the Conservation Trust Investment Study, and Ray sends his regrets as he's traveling and not able to join us today. So a quick overview of what I'm going to talk about today. I'll give a little bit of background on conservation trust funds and the CTIS, and I sort of assume if you've joined us that you know about conservation trust funds, but just to be safe, I'll give a little context. Share some results from calendar year 2018, and then as David mentioned, share some of the preliminary findings from the multi-year study that we're doing that draws on the CTIS database going back 12 years, and talk a little bit about what's coming up next. So just a quick background on conservation trust funds. They're private, legally independent institutions that provide sustainable funding for biodiversity conservation. And primarily that means they are grant-making institutions, although we occasionally see that they are doing some programmatic implementation as well. But their core function is to be grant-making institutions and catalyze resources for biodiversity conservation, which could be protected area management, research, other capacity buildings of programs for local CSOs, and other biodiversity conservation programs within the sphere where they operate, whether that's on the local or the regional or national or multinational scale. They work in partnership closely with the governments in their relevant region, with the civil society organizations and the local and indigenous communities in the places where they're working. They go back to the 90s. So the first conservation trust funds are about 25, 26 years old. We are in the process, and Amilcar, who is doing the gathering of this data, I see is on the webinar today. So we're in the process of gathering a comprehensive list of conservation trust funds around the world. We know that there are over 100, and we're in the process of validating those now. I think the list is up to about 130 or 140 that we're still confirming, and in various stages of creation, operation, or wind down. So that could be those that are still in the feasibility stage through actual full operations. We also know that, excuse me, collectively, they're managing over $1 billion US dollars in assets in the capital markets to fund this conservation work, and that's the focus of the CTIS. And we tend to see them both in, obviously, in areas with the highest biodiversity and particularly in developing or emerging economies where the national budget allocation does not cover the costs of full biodiversity conservation. And truly, we tend to see that across the board, right? That we don't have all the funds we need to support biodiversity conservation, but in particular, where the government has not been able to fully fund, the conservation trust funds can step in to fill that role. We recently mapped out the conservation trust funds that I'm sure exist, and we'll be adding to this as we validate more of them, but we're seeing over 100 in more than 70 countries around the world. They're marked there in red, the countries where we have conservation trust funds operating. And then in addition to that, there is the Blue Action Fund, which is a global marine fund, which obviously is not specific to any one geography, but funding marine and coastal conservation around the world. So I love this map. We'll continue, there'll be more red as we validate more CTIS. So a little quick background about the CTIS for anybody who's new to it. We gather and share the data about the investment practices and the performance of the conservation trust funds around the world. We started in 2006, so this year's study is the 12th, and it's produced by the Wildlife Conservation Society, WCS, in partnership with the Conservation Finance Alliance and the 3 networks of conservation trust funds, REDLAC in Latin America and the Caribbean, CAFE in Africa, and APNET, the Asia Pacific Conservation Trust Fund Network. It serves as a resource for conservation trust fund leaders, for their boards, for their donors, and also for the investment professionals who support the investment management of the CTFs. And often what we hear is that new conservation trust funds or parties who are thinking about creating a conservation trust fund draw on the CTIS data as part of their planning process to understand what's possible and where the best practices are. We very critically rely on the time and energy that it takes conservation trust funds to fill out the surveys. And the more participation we get, the deeper and broader the analysis can be. So huge thanks to CTF members who are on the call today for the time you take to fill out the questionnaires. We really appreciate it. Our database goes back 12 years, and we have consolidated all of the information that we've got, which allows us to do the multi-year study that I'll be talking about later in the webinar. Just a quick overview of the covers of the last 11 CTIS reports. In addition to the data, we also get really excellent photos from the Conservation Trust Fund community. So shifting into to talk about the investment results from 2018, just in general context, and if you were involved with the investments for your Conservation Trust Fund, you no doubt remember that 2018 was pretty challenging from an investment perspective, particularly because it seemed to be cruising along pretty well for the first 3 quarters of the year, and then really took a dramatic plunge in the 4th quarter. And some of the analysts were saying that the 4th quarter of 2018 is going down as the worst quarter for stock performance in I think like 7 or 12 years. I mean, it was a pretty dramatic turn of events. So equity returns were negative. The S&P 500 was at, that's the total return, S&P was at minus 4.4%, the developed markets index at minus 8.7, the emerging markets index at minus 14.5. And as I mentioned, we saw most of that decline happen in the 4th quarter of 2018. There were a number of factors that were contributing to market uncertainty and volatility. We saw conflicts over and uncertainty around US-China trade negotiations and signaling of what that might, what direction that might take, where some days the market was pleased and other days the market was very concerned. We saw uncertainty about Brexit and how that would relate to the European market and relationships between trading in London versus trading in the rest of Europe. And the US Federal Reserve Bank raised interest rates several times, which was a signal which tended to affect the returns as well. At the same time, the bond returns had started to improve in 2017, but we're back to basically zero in 2018. That's the Barclays Capital Aggregate Bond Index was basically at zero. So that's the context for the results from the Conservation Trust Fund's returns. So a little bit of background on the trust funds that have reported so far, and what I'd like to add for context, and so the reason that there's a little disclaimer about unpublished preliminary data is that we are still accepting responses. We're still chasing down some of the trust funds that regularly participate to get their data. And so what you will see today is most of the data, but there's still a couple funds out there that I'm hoping will provide their data. And so we'll accept that through next Wednesday and then put out the final data by the end of the year. So based on what we've got so far, roughly evenly divided in quarters in range of the size of their investments in US dollar equivalents. Basically a quarter in each category of 0 to 10 million, 10 to 20 million, 20 to 50 million, and over 50 million in investment assets. Regionally, the participation was strongest from Latin America and the Caribbean, making up over half of the participants, with each of the other three regions making up less than a quarter. Overall, we've got 27 participants so far. We'd like to see 35 to 40. You can, again, keep in mind that there are over 100 that we know of, and not all of them have investments yet. So getting to 35 to 40% participation is a much better number. And we're, as I mentioned, chasing down a few more participants. If any of them are you, please don't hesitate. Please send, we'd love to get your data. And if you have any questions about the questionnaires or how to get the information to us, please just let me know after the call. Of those 27 participants, 25 have provided their investment policy data, their overall strategy, how they approach investments, and then 19 have given us their actual results and returns from 2018. They range from, the smallest is just under 2 million in assets. The largest is over 107 million. They range from 3 years old to 26 years old. And the total combined assets that they've reported are 627 million. I know that there's another 300 million in assets outstanding. That's why I'm pretty comfortable, minimum 300 million, which is why I'm comfortable saying that combined, the Conservation Trust Fund community is investing over $1 billion in the capital markets. And when you think about it, that's a pretty impressive investment power that the Conservation Trust Fund communities have. So again, while each of them, we see them as small as 2 million in aggregate, that's a lot of investment assets out there in the world. A few quick clarifying notes about the CTIS methodology, because it can, the terminology that we use can sometimes be confusing. So we look at both the organization returns, which is to say we take a weighted average of all the individual investment funds that are held by that CTF. Some conservation trust funds only have one endowment or have one in sinking fund, but many of them are holding multiple endowments for multiple purposes, and possibly a mix of endowments and sinking funds, where each of those funds has a specific purpose. So the organizational return is when we take a weighted average of all of those funds together, and then we report just on the organization as a whole, with each conservation trust fund counting as one. But we also look at the results by endowment and by sinking fund. So in this year so far, we've got 24 endowments and 13 sinking funds. And we'll look at the averages by of endowments only and of sinking funds only. When we look at the overall average of fund returns, that means we've combined all the endowments and individual endowments and sinking funds together, along with anyone who reported them to us as combined funds. So in some cases, the CTFs are investing their endowments and their sinking funds in one portfolio, and they give us those combined numbers. And that's when we refer to overall fund averages, that's what we mean. So when you see a discrepancy between organization averages and what we call the overall fund averages, that's where that discrepancy comes in. It's the weighting. So I'm first going to talk about nominal returns. And the nominal returns are just the investment returns after funds have paid their fees but not taking out anything else. It's the face value of the return. And there's some pros and cons to looking at that. It does give us a pretty good face value picture of what's been going on. Well, I'll talk in a minute about some of the challenges with the nominal returns, but it gives us the preliminary picture. And what we saw is that organizationally, the mean and medians were just below zero. Even the 25th percentile was just below -5%. The endowments were pretty much tracking the same as the overall organizational returns. The sinking fund returns were a bit higher, so they tended to be on the average positive, less than 5%, but positive at least. When we compare those to some of the benchmarks that we tend to look at, the Barclays Capital Aggregate Bond Index, which is the measure of bond returns, which, as I mentioned, was tracking at zero. The S&P 500 at just almost -5%, and the MSCI World, which was at nearly -10%. The trust funds actually were doing better than a lot of the indices. And one of the things that we look at just for comparison, we've been tracking this over time, is a hypothetical portfolio that is 60% equities as measured by the MSCI World and 40% fixed income as measured by the Barclays, the BCABI. And the trust funds are actually on a nominal basis are doing better than the benchmarks this year. Even though the returns were negative, they're less negative than the benchmark. Now, one of the reasons for that is that, as I mentioned, these are nominal returns. They do not take into account inflation. And it means that they're also distributed across a lot of investment markets, not just trust funds that are invested in euros or in dollars with accounts in the US or Europe, but also some funds that are fairly heavily invested in their own domestic markets, where both inflation and returns tend to be higher. So on a nominal basis, some of those domestic investments will tend to skew the overall returns higher. And that's, I think, part of what we're seeing in this case is that some of those domestic portfolios are drawing the overall averages up on a nominal basis. But nonetheless, the trust funds, I would say, did better than the benchmarks this year. And that's a good thing to see. But as I mentioned, the problem with nominal returns is that you get a lot of skew or a lot of noise from the lack of comparability between an investment, a conservation trust fund that's invested in euros in Switzerland or in London versus, with accounts in Switzerland or London versus a fund that's invested in dollars with an account in the US versus a trust fund that's holding all of their investments in their local bank or their local investment firm. So one of the reasons that we look at real returns, which are the returns after inflation has been taken into consideration, is that it allows us to sort of normalize, to get a sense of how do you take the effect of high inflationary environments out of consideration and get at something that's a little more comparable across the board. And so when we take inflation into consideration, then we see that the real returns are not looking as strong. So overall, and just for context, on average, the average inflation rate for this group was about 2.9%. So it's not exactly the formula, but it's roughly subtracting 2.9% from the nominal returns gets you to the real returns, approximately. So so we see that overall, looking across all of the endowments and sinking funds and combined funds, the overall return drops from 0.5% down to -1.7%. Similar drop, endowments went from a little bit negative to more negative. The sinking funds, which tend to be the most likely to be invested in a domestic portfolio, dropped from 3.3% to just barely above zero when inflation is taken into consideration. So that gives us a frame of reference for how things went last year. And I'll talk in a few minutes about why inflation is particularly important for endowment investment returns. One of the things that I looked at is how the real returns have averaged over time, looking both at those overall numbers and then the endowments and sinking funds separately. And while there's been some fluctuation and variability, what we're seeing is that on a 6-year average, the real returns have been between 1% and 2%. And the reason why that's relevant is that when you think about how conservation trust funds spend and what their target spending might be, usually 3 to 4% of their investments, at least for endowments, is what CTIS are hoping to spend. That if they also want to cover inflation as part of their investment strategy, once they've covered inflation, they're not hitting returns that would actually allow them to spend 3 or 4% without actually digging into the principal. Now, what we see is that, in fact, the trust funds are spending 3 or 4% a year, so they're not actually covering inflation as part of their investment. Whether it's part of their investment strategy or not, it's not been part of their practice. So part of what we wanted to think about is is that true across the board? And if not, then what are the portfolios or what are the strategies that have been most effective over the last several years? And so that leads me into the multi-year study that we're doing. And for some context, the CFA launched over the summer call for proposals for 2 related conservation trust fund projects. One is a 10-year review of conservation trust funds. It's building on 10-year reviews that have been done over the last, this will be the culmination of 30 years of them. So the most recent one people tend to refer to as the Rapid Review. It was written by Barry Spergel and Philip Taib in 2008. And this 10-year review is building as the sequel to that one. In addition, the other project is an update to the practice standards for conservation trust funds, which originally came out in 2013, 2014. The update is going to include 4 new topic areas that were not able to be included in the first edition. So the multi-year study of investment returns is being done in conjunction with that 10-year review of CTIS. And we're looking for what trends and insights we can draw out of this 10 years of data that we've got, which essentially are how are the CTIS doing over time, and which portfolios, as I mentioned, have been the most successful, what strategies have been the most productive and resilient in conservation trust fund investment management. So I mentioned that there's a reason why we care about inflation, and the reason is that endowments are intended to be invested in perpetuity. Their goal is that they preserve intergenerational equity, which means that current generations and future generations get the same benefit from the investments. And the way that that happens is by covering inflation. So we focus in this multi-year study, we're focusing on real returns because they're so, because that inflation consideration is so important to endowment management. We're focusing on endowments on the whole for 2 reasons. One is that almost all the conservation trust funds have at least one endowment. They may also have a sinking fund, but for the most part, everybody's got at least one endowment. And endowment investment management tends to have a relatively consistent strategy over time, whereas sinking fund investment strategy depends a lot on where where you are in the term of the sinking fund, right? So the way that you would invest a 20-year sinking fund at the outset of the 20 years is going to differ from how you would invest it in the last 1 to 3 years of the fund before it sunsets. And because of that, it's a little too hard to, you saw in this, we've got 13 sinking funds reporting right now, all in different stages of their life. It's too challenging to try to narrow down how do you compare among investment strategies for those. But for the endowments, we have a pretty big pool of information and a fairly consistent approach to investing, or at least goals of investment. So that's why we're focused on the real returns that take inflation into consideration. As I also mentioned, inflation, looking at the real returns, helps us normalize to a certain extent across currencies and markets. Not completely, but it gets us closer to really being able to compare apples to apples. The initial study right now, we've looked at 2012 to 2017, and as I mentioned, focusing on endowments, real returns, and looking at the mean and median returns, and then at the top 5 performers and the bottom 5 performers in each of those years. The full study will be more comprehensive than that, and will obviously include 2018 as well. But this is where we are so far with the first look that helped us develop more questions for the next round. So here's what we've been seeing. And these numbers differ a little bit from the ones I showed you earlier, mostly because it's a slightly different data set. I'm drawing on slightly different pools of who's reported. So just in case you're wondering why there's maybe a point difference here or there, that's why. So what we've seen is in the mean and the median, the real returns have ranged from just under 1% to nearly 4% at both the mean and the median. And so what that would mean is that if you were the average conservation trust fund, and these are, I should clarify, are 3-year averages. So the 3.7 mean for 2014 is a 3-year average of 2012, 2013, and 2014, or the 3-year average ending in 2014. So again, if you were the average conservation trust fund, you would be able to spend, if you were going to recapitalize inflation every year, between 1 and 3.5 to 4% of your endowment on conservation activities. And that might be fine, but for most conservation trust funds, the target is higher than that. It's to consistently be able to spend 3.5 to 4%. And so specifically what we wanted to look at, and again, I should clarify that while this is what you would predict based on the data, conservation trust funds are definitely spending more than 1 or 2%. And partly that is because the need is great and they need to be able to spend that much. In some cases, it's a strategic decision to prioritize current spending over future spending. But in some cases, it's because whether the returns were there or not, they just needed to spend the money, and so they did, or they're not considering inflation in their analysis, or they're not trying to recapitalize inflation. So in some cases it's deliberate, and in some cases it's perhaps a bit accidental. But specifically what we wanted to look at is not everybody is the average CTF. So what's the variability between the top performers and the bottom performers? And what we saw in the top performers, again, looking at the top 5 returns in any given year, those top performers can definitely comfortably spend 4 to 5% after inflation and still grow even above inflation. So they can hit their 4 to 5% spending targets, recapitalize inflation, and then recapitalize beyond that, because they're hitting between really between 5 and 10%, in some cases 5 to 15% real returns. So the top performers are actually doing fine. The bottom performers are consistently negative, and so what we really wanted to understand is what's the difference between those top performers and the average or the bottom performers. What are they doing that's working? I will highlight that it's important to note that we also had to think about consistency, because those top performers are not necessarily the same funds every year, right? It's just whoever were the top 5, regardless of whether they were consistent or not. So we wanted to know, how consistent are they? Among those top 5 performers, there's one fund that has been in the top 5 all 4 of those years. There's a fund that's been in the top 5 3 of those years, and 4 funds have been in the top 5 at least 2 of those years. So there is some degree of consistency in who's showing up at the top. There are 6 funds that have been in both the top 5 and the bottom 5 performers, which means that those portfolios are neither consistent nor predictable. And for those of you who have served as the finance manager or the business manager, the person in charge of spending within a conservation trust fund, trying to manage cash and trying to manage a budget, consistency and predictability is really valuable. So volatility creates uncertainty. Being able to have some assurance that the strategy is going to return a predictable return based on market conditions is part of the goal. And so we're also, the goal is to look at which portfolios have produced the most predictability as well. And then there are 3 funds that have been in the bottom 5 2 of those years, and were consistent bottom performers. So what are the conclusions that we can draw about what's working or not working? What we've seen among the repeat top 5 performers is that they're held in a hard currency, usually dollars or euros. That their portfolios are globally diversified, which is to say, while they might have local investments, it's a relatively small percentage of an overall portfolio that is invested around the world in multiple markets, and taking advantage of that diversification to recognize where there are market trends that you want to move into, but at the same time hedging some risk when any one market might be highly volatile. On average, and this is, I'm going to be very clear to say this is not a portfolio recommendation, but it is a kind of a clear average, that on average those portfolios were about 60% equities and alternatives and 40% fixed income and cash, with cash as a relatively small piece of that 40%. And consistently they use professional outside portfolio managers. So they are relying on investment management consultants or financial advisors, not just for fund assets allocation, but also for help with portfolio manager selection and portfolio theory. I cannot draw as many conclusions about the bottom 5 performers. So while it's easier to say here's what's working, it's a lot harder to say here's what's not working, because there's just too much variability in what in the characteristics of the portfolios that ended up in the bottom. But that's part of what we'll be looking into in the longer term study is can we draw conclusions about not just about what's working well, but what might be working not as well. So the key questions that we're at least initially starting with, and I'd be interested in the discussion shortly about other key questions that people have for this multi-year study, really understanding how the investments are performing over time against their own expectations, against the benchmarks that they're using, and against other communities of foundation investments, so other peers that are not conservation trust funds. The CTIS was originally conceived based on what's called the NACUBO study, the National College and University Business Officer, North American College and University Business Officers. It's the colleges and university endowments in, particularly in the US and Canada. So when you see a report that the Yale endowment or the Harvard endowment had a whatever crazy return, that data comes from the NACUBO study. And while the conservation trust funds are not, don't have exactly the same investment profile as college and university endowments, it does provide some interesting peer context and one of the best sources of information we have on how other foundation or institutional nonprofit investors perform and what portfolios they're using. And then, as I mentioned, we're interested in resilience. How well which portfolios have the best resilience to changes in the market, which is to say, in a down year like 2018, everybody is probably going to take a hit. The question is, how resilient is your portfolio to not see wild volatility when there are market fluctuations? And that again goes to the predictability and the consistency. Can you pretty much have a good sense that the portfolio you've designed is going to provide predictable results within a range of expectations and not be swinging all over the place? So what you can expect from the CTIS in the next couple months, the goal is to publish these 2018 results by the end of 2019. As I mentioned, we will continue to accept data through next Wednesday, the 18th. And our plan for this year, because our focus is on the multi-year study, 2018 results are going to be in a summary form. So rather than the full report, which tends to be 40-something pages, we'll do a high-level summary with a lot of charts and graphs, but a lot less text. The goal is to put out the multi-year study by February of March of next year, and we're working with, there's a CTF projects task force of the CFA that is guiding the work of both the 10-year review and the update to the practice standards. They'll provide input to the goals and questions of the multi-year study. The CTIS Advisory Committee is a group of investment professionals and others who work closely with conservation trust funds on investment issues, including some CTF executive directors. They will also be providing input and guidance into the multi-year study and the key questions. And then the plan is to launch both the full 10-year study. So this, I should clarify that this multi-year study will be an ancillary report to the full 10-year review of CTFs. And those two work products, the 10-year review and the update to the practice standards, will be launched at the World Conservation Congress in Marseille, France in June 2020. So as David mentioned, the CFA also has some other meetings and webinars coming up that are of interest to conservation trust funds. And so I just wanted to highlight them. You can find the details on all of these things on the in the newsletter that just came out. And if you didn't get it, please go to the CFA website and make sure that you're signed up. But also on our news and events page, you can find the details on these upcoming meetings and webinars. So next week on the 16th, the Environmental Funds Working Group will be holding an online meeting. On the 17th, the Protected Areas Working Group will be holding a webinar on a recent survey that they did earlier this year to understand the needs and concerns of protected area managers. And then in January, we will have 2 webinars on the just newly launched this week Conservation Finance Alliance Incubator, which we put out a call for proposals this week. You can find more information on the CFA website. If you want to learn more, you can come to the webinars in the beginning of January. And then also in mid-January on the 15th, there's a webinar on blue funds in Costa Rica. We'll be talking about blue fund investments related to Blue Challenge. So that's what we have coming up, and I think we hopefully have time for some questions and discussion. So thank you.
Thank you, Katie, and Ray in absentia. Excellent. Well, that's quite a lot of information, and really, in many ways, a little worrying, I would say, to see, that the returns on average have been, kind of sort of lower than what people expect, and what people desire. So very interesting to have it all laid out. It just shows how important this study is for our work. So let's go to some questions. We have a question from Mark here. You want to unmute yourself, Mark, and ask directly?
Sure. Thanks for the presentation, Katie. I was just wondering if the fees reported are before or after investment management fees, and both the investment manager and any underlying fees charged by the funds that they're invested in. And did you try to collect any data on the fees that the CTFs are paying for investment management? Thanks.
Thanks. That is a great question. These are all after fee returns. So but we do collect data on how much the trust funds are paying in fees, both for consulting advice and the range of fees that they might pay, custodian fees, transaction fees, et cetera. So we gather that data. We'll include that in the final report for the year. There tends to be a really interesting range of volatility and in how much funds are paying for investment services. And related to that, we still push to understand whether, we started asking much more detailed questions about the fee structures in the last couple years to try to get a sense of whether trust funds are really getting clear information about what they're paying. And for the most part, I would say that is more clearly understood than I think it was maybe 5 or 6 years ago. Most of the trust funds are still comparatively small as clients, and so they are paying more than they might ideally want to. And we're seeing a trend towards pooling so that conservation trust funds can get the benefit of larger size. So the bigger they are, the lower fees that they pay. And pooling is one of the ways that they can try to minimize those transaction and consulting costs.
Great, thank you. Do we have any other questions? I'm sure there's lots of questions. Again, it's quite a fair amount to absorb. So Libby has a question. Would you like to unmute yourself?
Yeah, can you hear me okay?
Yes, we do.
Hi, this is Libby Kamala. I'm with World Wildlife Fund Northern Great Plains office, and we're trying to support the development, potentially, of a conservation trust fund. So this is really interesting. Thank you very much. I'm just wondering if you could speak about the sample size that you're using. So do you feel like the folks who are responding to your survey are reflective of the broader, the whole of the conservation trust funds that are out there?
That is a great question. Most years I would say yes. This year I will say yes when I have about 7 to 8 more responses, which we really are actively twisting arms. So I'm pretty confident we'll have them before the final data comes out. I think they are reflective of the most active conservation trust funds that are actively investing. There are a number of conservation trust funds that are either relatively, they're either small, they're not, they may actually be holding their investments entirely in their domestic treasury. So where the government has a fair amount of influence over how the funds are invested, and they don't report data. So I know that they're not skewing these results. I think that we have results from the largest conservation trust funds. I am sure that there are a few, quite a number of relatively small ones in the, 1 to 2 million range that are not reporting, but I think they're not really the norm. So so I would say it's a qualified yes. I would say in an average year, I think it's a pretty solid sample. And when I have more data for this year, I will think this year is a solid sample as well.
Thanks.
But I will also clarify that there is a, I mean, as highlighted by that, top 5 and bottom 5 study, there is a lot of variability. And so one of the reasons I think this multi-year study is going to be important is that we need to learn as much as we can from what the strongest portfolios, the strongest CTFs are doing, and focus our energy on looking at, the best ones and not, and hoping to bring the overall average up.
Thanks, Katie, and thanks, Libby, for the question. And Kathy McKeaton, over to you.
Yeah, hi, Katie, hate to put pressure on you. And I think it is unfortunate that we have a relatively substantial number of funds that haven't reported. And provided you do get everyone's inputs next Wednesday, when do you think we might have the CTIS 2018?
Oh, my goal is, that's why I'm telling people Wednesday, so that I can have it out on Friday before I go on vacation for the week.
Oh, wow. Okay, that's really fast.
Yeah, I mean, at this point, it's just adding in those last 7 or 8 funds. And then, but again, as I mentioned, the plan is that what we're going to put out for 2018 is really a high-level version. It's not the full report that we put out most years, so that we can put the energy into a more expansive report that's in for the multi-year study.
Okay, thanks.
So, not the 40-page version with a lot of pictures. It probably will be more like a really detailed slide deck.
Okay.
Excellent, thanks. Any other questions, people? Please don't hesitate to just, signal that you've got something to ask in the chat box. But Katie, I have a question here. You talked a little bit about the sinking funds and why they were doing better, but why would the strategy for sinking funds be that different? And do you think that's a real difference, or is it just a sampling error?
I think based on what I see, there is a strong tendency to put sinking funds entirely in local investment vehicles, often fixed income, and in some cases they're in like the equivalent of a CD ladder. They're not in mutual funds or diversified portfolios. They're in a combination of bond instruments, local bond instruments, government treasury bonds. And so we are seeing some skew because some of those domestic markets will have some really high returns in some years. They might turn around and have a really low return the following year. But that's what I'm tending to see, is that a lot of the sinking funds are, even if the Conservation Trust Fund invests its endowment offshore and in a diversified portfolio, the sinking funds are local and in T-bills or 3-month, or 1 to 2 month, 2-year government bonds. And so that's what I think is creating the skew. And I don't know why. I mean, there is obviously a liquidity need for sinking funds that you don't have in quite the same way with endowments. But if it's a 20-year sinking fund, I mean, there is a core of that money that you're not going to need to access for 15 years. So you could definitely put it in some longer term investment vehicles that are tied up for longer and see some higher returns. And I shouldn't say higher returns, I should say more consistent returns that are less volatile, more consistently growing, and consistently covering inflation.
Right. Thanks. Yeah, I mean, Kathy was just adding to that, saying that a lot of them were created by TFCA, the Tropical Forest Conservation Act, and held in local currency.
Yes.
Yeah. So anyway, very interesting. Libby, you did have another question. You're welcome to ask that.
Thank you, and I apologize. There is Johnny Cash blasting from a car outside my office window, if you can hear that.
We can't hear it, but
okay,
we love
good.
Johnny Cash.
Me too, but anyway, I'm curious, like, if you are looking at the top performers, if your study delved at all into what they were actually investing in terms of, like, are they investing into more like sustainable sorts of things, or are they like not excluding things like fossil fuels and things that would normally be left out of like more sustainable or equity oriented portfolios? And sorry if I'm not using the right lingo. Financing is not my background.
No, that's great. That's actually, it's a great question. And we do ask. So, I mean, we don't have details on specifically what funds they're investing in, but we ask them whether they have prohibited investments and whether they're using different tools for sustainable investing, which can range from negative screens where you eliminate entire industries or eliminate specific companies within those industries for being poor environmental actors, to other tools that are overweighting the best performers, the funds that, or the companies that are showing the strongest sustainability. I mean, just as a quick aside, one of the challenges in trying to get completely out of certain industries is that some of the within, like, for example, within the energy sector, some of those companies are diversified themselves, right? So that while they might be in carbon heavy activities, they're also in renewables. And so if you divest from them completely, you've cut out both the bad actor half and the good actor half, because they've started diversifying themselves. So that's just an aside to say it's a complicated question about how you approach this. The issue that we run into is that while we know what the CTF's intentions are in some cases around what I would just call sustainable investing, it's really around aligning your investment strategy with your mission. The challenge is that actually executing it is a lot harder. And what I am not sure is happening is that investment committees are actually holding their investment managers accountable for what they say they want. So they may say, sort of big picture, we don't invest in environmentally destructive industries or companies, but on a practical basis, I'm just saying anecdotally, I'm not sure that they're actually verifying that that is in fact what their portfolio looks like. And so it's a topic for deeper questioning. It's a little hard to get clear data on that, but we keep asking the question. And I should add that there are a lot of groups that are looking into this heavily. Lorenzo Rosenzweig, who runs Fondo Mexicano, is really active with a group called Confluence Philanthropy, which is out of San Francisco. There's a group called the Intentional Endowment Network, which is mostly US colleges and universities, but is open to other foundations as well. That one's based out of somewhere in the US Northeast. And there are a couple other groups as well that are really looking at that alignment question around sustainable investing.
Thanks, really helpful.
Great. Okay. Thanks for the question. And Mark, you had another question here, so why don't you go ahead?
Thanks. Yeah, thanks for allowing me a second question here. I was just wondering if you took a look at a breakdown of the equity investments of the funds and whether you noticed any biases toward making investments either domestically or regionally, and whether that could be having a negative impact on returns. If you look at kind of long-term data, the U.S. equity markets have been outperforming international markets for a long time, and I'm wondering if you found kind of an underweight of U.S. equities and whether that could be impacting returns.
Yes, that is a great question, and yes, definitely. And it's not necessarily underweighting the U.S., although to some extent that may be happening. The European investors will point out that even when they invest more heavily in U.S. markets, they sometimes take a hit on currency exchange. But the issue of interestingly, at a panel at the Red Lac Assembly this year, Juan Ettinger talked about biases risk as one of the risks that we should talk about, and to my opinion, don't. He was talking specifically in investment context, is that we absolutely see a bias towards domestic markets among conservation trust funds. We see when we push on that and ask them specifically why such a heavy domestic or regional weight, it tends to be that they feel more comfortable, that they actually feel those markets are less risky because they can see them. They know, it's familiar and knowledgeable, and the global markets seem remote and complicated. But the flip side of that is that they are incurring a significant amount of non-diversification risk. They're significantly overweighted towards the risk in their own local economy or their own region, and it plays into their long-term resilience, their real returns potentially being negative even when their nominal returns are high. So the only way we've just consistently been trying to do education around where those risks are, why domestic investment, solely domestic investment. I am all for, I think a portion of investments in the domestic market is important. The question is, should that be 5% or 75% and or 100%? The other thing that's interesting in conversations that I've had with donors has been that in some cases the trust funds believe that they're doing what the donors asked for, but the donors don't necessarily see it that way. I've had conversations with one or two donors who have said, I think that there's been some misinterpretation about what we were saying when we said invest conservatively or invest prudently, and that it's been interpreted to mean invest exclusively domestically when that wasn't the intention. So we're starting to see some shift there as well, as we've both talked to more donors and also done more. The CFA has a whole investment management workshop that we can run. We've run it at Red Lac as well as for a few intact boards. And we start to see more understanding of why overweighting the local investments might be riskier than was initially perceived.
Yeah, thanks, Katie.
That was a really long-winded answer to your question.
No, but it merits the discussion, right? Because it's really the asset allocation that is driving returns. And if I were a donor, I wouldn't be happy with these returns on average, right? And if there's miscommunication, it'd be great if you can play a role in helping to, to make it more clear what the donors are looking for. Because if as a donor, I want to maximize returns, right? I want money to go to conservation, period.
Right. For a reasonable amount of risk. Not maximizing returns at any cost, but definitely within a prudent risk profile.
All right. Great. Well, I believe our time is up. Really want to thank you, Katy, for the presentation and the work that you've been doing. And I think that, and thanks everyone for joining and contributing your questions and thoughts. It's such an important area, and I feel like we're kind of just eating at it from different, looking at it from different angles. And at some point in your multi-year review, you're going to pull it all together and provide us with the insight that everyone's hoping for here. So, and to really move the. No pressure. You just have to solve this whole problem. But other than that, no pressure. But anyway, what a great presentation, and thanks everyone for joining. And hope to see you at a next webinar coming up. And if you know anyone that wants to that couldn't come to this one, but wants to see the presentation, not only will there be a recording of this, but there'll also be another webinar tonight, 9 p.m. Eastern time, where Katy will offer this for those who in different time zones. Okay, well, thanks again, everyone, and thank you, Katy.
Okay. Thanks, everybody.